You studied the charts, you read the books, you followed the strategy, and you still lost. And the worst part? You lost again, and again, and again. If this sounds like you, this video is going to be the most important thing you ever watch as a trader. Because today, we're not going to talk about indicators. We're not going to talk about setups. We're going to talk about the real reason you always lose. Before we dive in, let me hit you with a number that should shake you. According to the largest longitudinal study ever done on retail trading, 8 million traders, 295 million trades across 27 years. Between 74% and 89% of retail traders lose money every single year. Across every platform. Across every education level. 27 years of data. The number hasn't moved. The failure rate of retail traders in 1998 is almost identical to the failure rate in 2025. So the question isn't, what's the next indicator? The question is, what is happening inside your brain, inside the market structure, and inside the minds of the big players that is systematically destroying retail traders? That's what today is about. Let's go. Let's start with the data, because most traders have no idea how bad it actually is. 80% of all day traders quit within the first 2 years, not because they got bored, because they ran out of money. Only 13% continue to trade after 3 years. After 5 years, just 7% remain. FINRA, the Financial Industry Regulatory Authority, reports that 72% of active day traders end the year with a net loss. Only 1.6% of traders are consistently profitable in the average year. Now, here's the number that hurts the most. The average individual investor underperforms a simple market index by 1.5% to 6.1% per year. That means doing nothing would have made most of you richer than actively trading. And according to a study by Barco, Leon, and Ramirez, published in academic journals and analyzing all retail stock transactions on the Colombian Stock Exchange from 2006 to 2016, retail investors had consistent negative abnormal returns ranging from 4% to 4.4% per year, every single year. But here's what's fascinating and terrifying at the same time. Research by Barber, Lee, and Odean shows that traders with up to a 10-year negative track record continue to trade. Think about that. A decade of losing. And people keep going back. Why? That's where the psychology comes in. Here's a cognitive bias that destroys more traders than any bad strategy ever could. Overconfidence. Research synthesizing over 270 studies on behavioral finance found that overconfident traders generate approximately 45% higher trading volumes than their peers and earn 1% to 3% less per year because of it. Why? Because overconfident traders believe they have an edge they don't have. They trade more, they risk more, and they lose more. Terry Odean, a legendary behavioral finance researcher at Berkeley, found that securities purchased by individual investors consistently underperform the securities they sold by more than 2% over 1 year. Translation: retail traders are systematically better at picking what to sell than what to buy, and they don't even know it. Overconfidence also works through something called self-attribution bias. When you win a trade, your brain says, "That was my skill." When you lose, "That was bad luck. The market was unfair." This makes you blind to your actual edge or lack of one. Now let's talk about something called the disposition effect, and this one is going to hit close to home. Research shows that retail traders sell their winning positions at a 50% higher rate than their losing positions. 60% of your sales are winners, 40% are losers. You cut your winners short. You let your losers bleed. Why? Because of something rooted in prospect theory, a framework developed by Nobel Prize winner Daniel Kahneman. The pain of a loss is psychologically about twice as powerful as the pleasure of an equivalent gain. So your brain will do almost anything to avoid locking in a loss, including holding a trade that's going to zero. Research from Odean, Friedman, and others at top universities shows this plays out in a vicious cycle. You sell winners to lock in that good feeling, You hold losers hoping to avoid the pain of realizing the mistake. And slowly, your account drains. A recent study specifically found that this disposition effect actually feeds overconfidence because when you sell winners early, you see more wins than losses in your realized trades. Your brain starts counting wins, it thinks you're good, and you keep doing it. Here's another silent killer: confirmation bias. When you enter a trade, your brain starts filtering information. It accepts facts that support your trade. It ignores or dismisses facts that threaten it. Research on online trading communities shows traders create echo chambers where everyone in the group reinforces the same view. Reddit bull runs, Telegram channels where nobody is allowed to be bearish, Discord servers where questioning the trade gets you muted. You seek opinions that match your beliefs. You stop seeing the market. You see a story you told yourself. Then there's herding. When retail traders see a stock moving up sharply or see it trending on social media, they pile in. Not because of analysis, because of FOMO, fear of missing out. A 2024 study on cryptocurrency markets found that lottery-like preferences drive retail traders toward low-priced, high-volatility assets, even when the fundamentals are clearly against them. Institutions love this, because when retail floods into a trade all at once, it creates exactly the kind of predictable, exploitable price movement that professionals make their living from. The crowd gives the institution a roadmap. One more psychological bomb, then we move to the really uncomfortable stuff. Research has found that poor individuals tend to spend a greater proportion of income on lottery purchases, and demand for lottery increases when income declines. Sound familiar? When retail traders lose money, many increase their trading frequency. They try to make it back. They size up. They revenge trade. A 2023 analysis of 20,000 German retail investors found that behavioral biases accounted for 80% of excess loss in speculative trades, not market conditions. Not bad luck. Behavioral biases. Your brain isn't broken, but it was never designed for this game. Now, this is where it gets really deep. Because even if you were psychologically perfect, even if you had zero biases and infinite discipline, there's a second layer working against you that most traders never see. When you open your free trading app, when you hit zero commission, when you feel like you're getting a great deal, you're not the customer, you're the product. Here's how it works. When you place a trade on Robinhood, your order doesn't go to a public exchange. It gets sold to a firm called Citadel Securities, the single largest market maker in the United States, processing approximately 40% of all U.S. retail trading volume. Citadel pays Robinhood for your order flow. In 2020 alone, Citadel Securities made $6.7 billion in revenue, much of it from retail order flow. You saved $7 on commission. They made billions. This practice is called payment for order flow, PFOF, and it is banned in most countries outside the United States, Canada, the UK, Europe. They banned it because regulators decided it was a conflict of interest. What does Citadel know when they buy your order? They know you're retail. They know you're uninformed. They know statistically you're not going to outsmart them, and they position accordingly. A research document analyzed by the SEC put it plainly. Uninformed retail order flow is particularly valuable to wholesalers due to limited adverse selection risk. In plain English, your trades are easy money because they know you probably don't have better information than the market. Now let's talk about something that happens to you almost every time you trade. Something that feels like bad luck, but isn't. You set your stop loss. It's logical. It's at the swing low. It's at support. It's where everyone puts their stop. And then the market dips exactly to that level, hits your stop, and immediately reverses upward. Was that random? No. This is called a liquidity grab, or stop hunting. And it is a deliberate institutional strategy. Here's the logic. Large institutions, hedge funds, banks, market makers, need enormous amounts of liquidity to fill their massive positions. They can't just buy millions of shares in one order, because that would move the price against them. So they manufacture liquidity. They know based on where chart patterns sit, where support levels are, where psychological round numbers are, exactly where retail traders cluster their stop losses. They push the price into those zones. Stop losses trigger. Retail traders are shaken out. Now there's a flood of sell orders in the market. The institution uses those sell orders to buy at better prices. Then price reverses. You got stopped out of a winning trade. The institution accumulated a long position at the bottom. This is not conspiracy. This is market microstructure. It's how big money moves. And the stops that are easiest to hunt? The ones at the most obvious technical levels. Round numbers like 1.3000 in Forex. The prior day's high and low. Clear support and resistance zones. Fibonacci retracement levels. Swing highs and lows. Retail traders are predictable. They put stops in the same places every single time. And the algos know. Here's something else most retail traders don't know. Roughly 40% of all US equity trading doesn't happen on the public exchange you see on your chart. It happens in something called dark pools, private trading venues, where large institutional orders are executed without showing up on the public order book. Institutions use dark pools because if they tried to buy 10 million shares of a stock on a public exchange, the market would move against them before they finished filling the order. By hiding in a dark pool, they move massive positions without tipping their hand. What does this mean for you? Your chart is incomplete. The prices you see, the volume you see, the order book you see, it's showing you maybe 60% of what's actually happening. A 2025 academic study concluded that dark trading either reduces market efficiency or creates welfare losses, predominantly impacting retail traders who don't have access to these venues. You're playing poker, but the big players can see their cards and yours. And even before your order reaches the exchange, there are firms executing strategies at microsecond speed. High-frequency trading firms account for 50 to 60% of all US equity trading volume. These are algorithms that can analyze your order, anticipate what comes next, and position ahead of you, all within microseconds. Research on HFT firms found that they identify patterns in past trades and orders that allow them to anticipate and trade ahead of other investors' order flow. They literally predict that a wave of retail buy orders is coming, and they buy before you do. When you hit market buy on a fast-moving stock, by the time your order executes, the algo has already moved the price. You get a worse fill every single time. And here's one more layer. Hedge funds now use AI to monitor your social media, Reddit, Twitter, TikTok. If their models detect extreme bullish sentiment building around a small cap stock, they position long before the retail wave arrives, then sell into your buying pressure. They're not just faster, they're reading your mind in real time. The same study of 8 million traders found that 85% of failed trading accounts follow the exact same behavioral pattern. They called it the 4-phase spiral. And when I read this, I needed a moment. You start trading. You win a few trades. Maybe you get lucky early. Your confidence skyrockets. You start believing you have the edge. You size up. Now you're trading more frequently, taking bigger risks. The wins feel like skill. The losses feel like temporary setbacks. You're now overtrading, which research shows is one of the strongest predictors of failure. Studies show losing traders place 4 times more trades than winning traders. Frequent traders, executing over 500 trades annually, have a loss rate as high as 80%. A big loss hits, or a series of losses. You revenge trade to get it back. You double down. You abandon your rules. You start chasing. This is where most accounts are destroyed, not by one catastrophic trade, but by the emotional spiral after a normal loss. And then, this is the haunting part, you don't stop. Research found that traders with up to a 10-year negative track record continue to trade. They don't learn from the signal, because the losses are blamed on external factors, bad luck, manipulation. The broker, the market maker, anyone but the system, and then the cycle starts again. Euphoria, overextension, crash, denial. 27 years, The cycle hasn't changed. Now, the small percentage who survive, who are these people? What do they actually do differently? Here's what the data shows. Winning traders don't try to predict what the market will do. They understand they're operating under uncertainty, and they manage that uncertainty with defined risk. They don't ask, will this trade win? They ask, if I take this setup 100 times, does it have positive expectancy? The number one priority of a professional trader is not to make money. It's to not lose money. Because a 50% loss requires a 100% gain just to break even. Protecting capital is the foundation, not a feeling, not a vibe. A documented system with entry criteria, exit rules, position sizing, and risk per trade that has been backtested across thousands of scenarios. If you can't write your trading system on one page, you don't have one. Instead of placing stops at the most obvious support and resistance levels where institutions hunt them, smart traders either place stops beyond the liquidity zones or use the liquidity grab as an entry signal, not an exit. The 1.6% who are consistently profitable increase their trading activity. The unprofitable majority also increases their trading activity. Same behavior, totally different results. The difference? Profitable traders only trade more when the data says their edge is working. They review their journals. They know their stats. No business on earth risks everything on one day's sales. No business operates without a budget, without tracking expenses, without measuring performance. Yet most retail traders open their app every morning with no plan and wonder why they're losing. I want to be honest with you right now. Because I think you deserve honesty more than you deserve motivation. The market is a zero-sum game. Every dollar you make comes from someone else's loss. And in that game, you are competing against algorithms that execute in microseconds. Institutions with teams of PhDs, supercomputers, and private data feeds. Market makers who see your order flow before you do. Dark pools that hide 40% of actual market activity from your chart. Hedge funds that are reading Reddit, TikTok, and X to predict your next move. And your weapon? A retail trading app, a YouTube chart tutorial, and a $1,000 account. This is not to discourage you. This is to make you serious. Because here's the thing, people do survive this. People do become consistently profitable. But they survive it by treating it with the respect it demands. By learning the structure, by managing psychology ruthlessly, by understanding who they're actually competing against. The traders who lose aren't stupid. They're underprepared and undercapitalized, playing a game they don't fully understand yet. The first step to winning is knowing why you've been losing. So let's recap what we covered today. The statistics. 74 to 89% of retail traders lose money, and that number has not changed in 27 years. The psychology. Overconfidence, the disposition effect, confirmation bias, herding, and the gambler's spiral are killing your trades before you even click buy. The invisible game. Payment for order flow, stop hunting, dark pools, and high-frequency trading create a structural disadvantage that most retail traders don't even know exists. And the four-phase spiral that 85% of failed accounts follow. Euphoria, overextension, the crash, and denial. If this video helped you see the game more clearly, smash that like button, share it with someone who needs to hear it, and subscribe, because we go this deep on every single topic. And drop a comment below. Which one of these hit closest to home? I want to know. Trade safe, trade smart, and know your enemy, starting with the one in the mirror.